city just spent $2 billion on a stadium. The team plays 81 home games a year. Do the math. The gap between what a stadium costs to build and what it actually generates, that's where the economics get complicated. Most modern NFL or MLB stadiums run between $500 million and $2 billion to construct. The revenue they produce is real, but it's almost never enough to cover that initial debt on its own. So cities and states fill the gap with public money. Bonds, tax breaks, land donations, sometimes all three at once. The revenue streams are straightforward enough. Ticket sales, concessions, parking, naming rights, where corporations pay tens of millions just to attach their name to the building, suite rentals for wealthy patrons, and broadcasting rights which have grown enormous. A single team's media deal can exceed $300 million annually, yet operating costs are brutal. Player salaries, maintenance, staffing, utilities. The math rarely pencils out without that public subsidy. Why do cities do it? The pitch is always the same: economic development. A new stadium attracts businesses, creates jobs, increases property values around the venue. Tourism spending rises. Tax revenue flows back to the municipality. In theory, the public investment pays for itself over time through indirect economic activity, and sometimes that happens, but studies show the effect is often smaller than promised. Some economists argue it's negligible. The financing mechanisms vary widely. General obligation bonds backed by city tax revenue, sales tax increases dedicated to sports, public land donated at below market value. Sometimes a city floats a special district that captures property tax growth in the stadium neighborhood. Each approach shifts the burden differently onto residents, onto businesses, onto future budgets. And crucially, it's the public that assumes the risk if revenue falls short. Team owners benefit enormously. A new stadium increases franchise value by hundreds of millions. It's leverage in labor negotiations. It's collateral for loans. An owner who arrives in a city with a dilapidated venue can demand a public-funded replacement and walk away richer. The threat of relocation, of taking the team to another city hungry for that prestige, is powerful. Cities compete against each other for the same franchises. What often goes unspoken is opportunity cost. The same public dollars spent on a stadium could fund schools, infrastructure, affordable housing. A city choosing to subsidize sports is making a deliberate trade-off. Some communities have decided it's worth it. They value the team's presence, the identity it confers, the gathering space. Others regret it years later, especially if the team underperforms or leaves anyway. The economics of stadiums reveal something deeper about how we value shared spaces and public goods. We're willing to spend enormous sums on symbols, on places where communities gather. Whether that's a rational investment or an emotional one is something each city answers differently. The numbers are clear. The justification is less so. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you're curious about the hidden economics shaping the places around you, subscribe for weekly deep dives into how industries actually work. This video is for educational and informational purposes only and is not financial advice. Always do your own research.